Just before recessing for the holidays, Congress provided a welcome Christmas present to taxpayers with a surprising minimum of disruption for tax preparers by enacting massive year-end legislation known as the Protecting Americans from Tax Hikes Act. On the one hand, the PATH Act does exactly what you want typical tax extender legislation to do. It extends more than 50 tax breaks for our use in 2015. But on the other hand, it also makes permanent many of the more extensive tax incentives that we've relied upon and that have, until now, been temporary provisions. Though it falls far short of the comprehensive tax reform that both political parties have sought for years, the new package is a rare example of unified congressional action on a major economic issue. And as a result, your clients and you will no longer have to worry each December whether Congress will take the necessary action to extend certain tax relief measures.
Giving us the lowdown on the new tax law is Barbara Weltman. Viewers will recall that Barbara is the author of J.K. Lesser's Small Business Taxes, as well as other tax resources. Thanks for joining us again, Barbara.
Glad to be here, Mike.
Well, a new year means, once again, a new tax law. So let me start with the $64,000 question, Barbara. What impact will the extender legislation have on this year's filing season?
Well, you know, there are over 100 provisions. There are many rules covered in the PATH Act. Many of the rules, or most of the rules that applied for 2014 are going to apply for 2015 returns. For example, the exclusion for forgiveness of home mortgage indebtedness, the treatment of mortgage insurance premiums as interest, and the option to, when you're itemizing, to deduct state and local sales taxes instead of state and local income taxes. So there's a lot in there to look at.
Well, that's certainly good news. How does it compare to past extender bills that you've told me about?
Remember, some of the provisions were only extended through 2016, others only through 2019, so we'll need extenders for those rules to continue. And Speaker Ryan has indicated that he would like comprehensive tax reform before the upcoming November election. So when we say permanent, we gotta, you know, sort of hedge our bets here. We'll have to wait and see.
So in general, the new law is good news for our viewers and their clients. But let's get the bad news over with at the beginning of our segment. To what extent does the PATH Act contain revenue raisers or offsets that are going to cost our viewers' clients some money?
Yes, there were, mostly related to REITs and the Foreign Investment in Real Property Tax Act, FIRPTA, if you will, designed to encourage foreign investors in U.S. real estate. So it's you know, rather limited in where the revenue raisers were placed.
Thanks, Barbara. We'll return to your commentary in a minute.
As Barbara Weltman indicated, one of the main accomplishments of the PATH Act was to finally make many of the temporary tax provisions permanent. And one of those formerly temporary provisions is the ability to make what is known as qualified charitable distributions. You'll recall that under the law, individuals who are more than 70.5 years old can make direct transfer of their tax-deferred IRA savings to a charity. In other words, IRA funds that are distributed to the account owner and then contributed to charity do not qualify. So what's the big deal? Well, if you make a qualified charitable distribution, 1, the funds are excluded from your gross income. 2, the amount can satisfy your required minimum distribution, or RMD, for the year. 3, it will lessen your AGI for state as well as for federal tax purposes. And 4, your Medicare premiums, specifically for Part D and Part F, will decrease.
Over the years, Barbara, you've told me how valuable the qualified charitable distribution is for those individuals who are at least 70.5 years old. Is this provision now permanent?
Yes, again, welcome relief that this provision is permanent, and it means that we can now advise our clients in advance when it comes to their RMDs.
What about those clients who've got 401k accounts or Roth IRAs? Can they make qualified charitable distributions too?
Yes, it's for distributions up to $100,000 transferred directly to a public charity, And it applies to traditional IRAs and technically to Roth IRAs as well, although I can't imagine anybody depleting their Roth IRAs for this purpose because, as you remember, there are no required minimum distributions lifetime for Roth IRAs.
Okay, also on the list of now permanent provisions is the American Opportunity Tax Credit, formerly known as the HOPE credit. That's good news for college students and their parents, but what does it mean for tax preparers like our clients?
There's going to be a new due diligence burden on preparers. It's not going to apply for 2015 returns, so it won't impact us this tax filing season, but starting for next tax season, we're going to have to verify certain information in much the same way we do for the earned income credit.
Since we're on the topic of education, what about the teachers? Didn't I hear that their $250 above-the-line deduction for purchasing classroom supplies is now permanent?
Well, you're right, Mike. For example, the $250 educator above-the-line deduction will be indexed for inflation. For 2015 returns, we're dealing with the $250 limit, but in 2016, it could be indexed. It could be adjusted. We'll have to see. Also, I want to point out that looking ahead, professional development expenses are going to qualify for this deduction.
Well, those 529 college savings plans were already permanently in the tax code. I suppose there's nothing new for Congress to add to that section of the tax law.
Well, the rules are basically the same. The change is that now withdrawals for computers and technology are treated as qualified expenses, meaning that they're not going to be taxed, and it applies retroactively to distributions after December 31, 2014, meaning 2015 withdrawals.
Well, Section 529 reminds me that on last month's program, you told me about the new ABLE accounts under Section 529A. Aren't ABLE accounts too recent to crop up in the PATH Act?
It's in there. Actually, you're now permitted to make transfers from 529 plans tax-free to ABLE accounts. Of course, they're limited to the annual contribution amount for ABLE accounts, which for 2016 is $14,000.
Some of these extender provisions weren't made permanent. Now, tell me, what about the tax credit for energy improvements to residential properties? Did that get extended too?
Well, yes, the $500 credit has been extended, but only for 2015 and 2016. Of course, it's a lifetime cap, so if your clients took this credit previously, they're not going to be eligible for the credit now. But I do want to point out that the PATH Act did extend many other energy-related tax breaks. So you really want to look through the law to see the various energy-related breaks, credits, deductions, etc., that have been extended.
The subject of energy reminds me, of course, of how much money I'm saving at the gas pump these days. I'm curious, do we know yet whether these lower gas prices will have an impact on the mileage rates we use for tax purposes in 2016?
Well, yeah, rather dramatically this year. The business rate is now 54 cents a mile. That's down from 57.5 cents a mile in 2015. For medical or moving purposes, the rate is now 19 cents a mile. In 2015, it was 23 cents a mile. And of course, the rate for driving for charitable purposes is a statutory rate of 14 cents per mile, so that doesn't change. Using the FAVRA plan allows you to use the standard mileage rate as a substantiation method when you're reimbursing employees for driving their personal vehicles on company business.
Okay, that's for taking deductions based on your driving. But doesn't the service also set a mileage rate for depreciation purposes too?
Well, the deemed depreciation rate remains at 24 cents per mile. This is the rate that you have to use to adjust the basis of the vehicle, and you use that for determining a gain or loss when the vehicle is sold.
And since we're talking about driving, what about those employers who provide fringe benefits to their employees that take public transit or use van pools?
Well, yes, it's been restored, and not only that, it's been made permanent. So now we have permanent parity between all the transportation fringe benefits other than bicycling. And what it also means is that we may have to revisit our payroll taxes for 2015. Again, this is an exercise we've been through before with extenders, so we kind of know what to do. And again, the IRS may come out with additional guidance on this point.
For years, we've avoided on this program any discussion of the research tax credit. After all, for our viewers and their small business clients, the credit is viewed as being the province of big business. But there are two items of good news affecting our viewers and their clients about the research credit in the PATH Act. First, as expected, the largest and costliest component of the new law is the now permanent research and development tax credit, which will cost $113 billion over a decade in lost government revenues. This credit is available to those companies with specified increases in business-related qualified research expenditures, as well as for increases in their payments to universities and other qualified organizations for basic research. But the big change is for small businesses with less than $5 million in gross revenues. Beginning in 2016, these businesses, including startup companies, may elect to use their qualified research expenses as an offset to their payroll tax liabilities up to $250,000 on Form 941.
Well, let's start with the most expensive provision that was covered by the PATH Act, the Research and Development Credit. Was it really made permanent?
Well, the good news here, the research credit is now finally at last permanent. And the rules are basically the same.
But what about our viewers' small business clients, including so-called startup companies? Now, they are typically doing a lot of research and experimentation, but often aren't profitable and can't really use an income tax credit. Is there any way for them to take advantage of their R&D expenditures?
But there is one good new wrinkle in this that and it primarily helps small businesses. They're going to be able to take the research credit as an offset to employer Social Security tax liability rather than against income tax liability. And this is a benefit for small businesses engaged in R&D that may not have any revenue or any profits and no income taxes, but they are paying employees and have employment taxes.
Since we're talking about tax credits that aren't permanent parts of the tax code, Barbara, let me ask you about the so-called work opportunity tax credit. With unemployment down near the 5% level, that wasn't made a permanent part of the tax code, was it?
Well, first, the work opportunity credit is certain through 2019. Of course, you can only claim the credit if the employer submitted Form 8850 in a timely manner to the state workforce agency to make sure that the worker is certified belonging to a targeted group, which would entitle the employer to the credit.
Well, that's good news. But the work opportunity tax credit wasn't officially part of the tax code in 2015. So tell me, Barbara, what if businesses hired employees last year who would have been eligible for the WOTC? Is it too late to get the tax credit?
Well, I don't know if past performance is any indicator, but previously when there was extender legislation, the IRS came up with guidance. For example, when the provision was extended for 2014, the IRS gave employers until April 30th of 2015 to timely submit the forms. So I guess the bottom line is we have to watch and see what's going to come from the IRS on this matter.
Just like the research credit and other provisions of the PATH Act, the law for 2015 was made essentially the same as 2014. But Congress did make changes in some of those provisions that are going to be effective in 2016. Now, I'm curious, does the work opportunity tax credit have any new wrinkles?
Yes, for 2016 and through 2019, but not for 2015. There's a new category for long-term unemployed. This is someone who's been unemployed for at least 27 weeks.
Well, that's helpful. But I suppose that targeted group that gets the most attention is when businesses hire veterans, right?
Well, I just want to make it clear, not all veterans qualify, but there are 5 subcategories of veterans for whom an employer may be eligible for a work opportunity credit by hiring them.
As you might expect, the PATH Act contains many favorable depreciation changes for businesses. For instance, first-year bonus depreciation has been a benefit for companies that place new property in service ever since September 11th of 2001, with the exception of a 3-year hiatus from 2005 through 2007. Although the new law does provide for a gradual phase-down of bonus depreciation, the good news is that there will continue to be an immediate write-off for new property for 2015, 2016, and 2017 at the rate of 50% bonus depreciation. For 2018, it will be 40%, and for 2019, it will be 30%. Unchanged are most of the rules as to which property qualifies for bonus depreciation. As a general rule, essentially, bonus depreciation will continue to apply to 1. Tangible property with a recovery period of 20 years or less, 2. Off-the-shelf software, and 3. Qualified improvement property that's used for leasehold, restaurant, and retail properties. But before we get to bonus depreciation, what's the news about the Section 179 deduction that's available to small businesses?
It's an annual waiting game, isn't it, Barbara? What's the story on the deduction limits for Section 179 elections for 2015? Is there any way to make that permanent so we actually know the amount before the year begins?
Well, in the same vein, the $500,000 limit for the Section 179 deduction has been made permanent, but starting in 2016, it's going to be indexed for inflation, as will the $2 million threshold for the phase-out of this deduction. What's more, starting in 2016, air conditioning and heating units are going to qualify for the Section 179 deduction.
Let me ask you about the bonus depreciation provisions, Barbara. Are they going to be permanent, like the research credit is, or just for the next couple of years, like the work opportunity tax credit?
Well, it's not permanent, but it's been extended through 2019. For 2015, 16, and 17, we have a 50% bonus depreciation deduction. For 2018, it's going to decline to 40%, and for 2019 to 30%.
You know, on last month's program, you mentioned the new safe harbor for remodeling and refreshing restaurants and retail stores. But didn't we also have a couple of depreciation provisions that allowed for a 15-year write-off of qualified improvement property?
Well, you're right, Mike, but the 15-year recovery period has now been made permanent. And there's more. The Section 179 deduction for these properties has been capped at $250. Starting in 2016, that cap has been eliminated.
You probably won't be surprised, but the new tax law, as well as recent developments at the IRS, have changed some of the rules we reported to you a few months ago about the Affordable Care Act. You may recall that the ACA added an information reporting requirement for employers that's taking effect right now. Tax Code Section 6056 requires so-called applicable large employers to provide an annual statement to each full-time employee detailing the employer's health coverage. And we reported to you that the service designed a new form, IRS Form 1095-C, for large employers to satisfy their information reporting requirement. In addition, there is a transmittal form, IRS Form 1094-C, that employers must file with the IRS, aggregating the information contained on the individual forms distributed to workers.
Okay, Barbara, this is the first year that employers are preparing IRS Form 1095-C for each worker, detailing the extent and the cost of their health coverage. People are viewing this program at the same time that they've sent out their W-2 forms to their employees. Aren't the health care forms supposed to be due at the same time as the W-2 forms?
Well, yes, technically they have the same deadlines. However, I guess because this is something new, the IRS has provided transition relief for 2015 information returns that are due in this year.
I heard that the due date of the 1095-C form to employees has been postponed from February 1st, 2016 until March 31st, 2016. And what about the other form, the transmittal form? When does that due?
Well, the 1094s, which would have been due February 29th, The due date is now May 31st, 2016. And if you're filing electronically instead of March 31st, we're talking June 30th of 2016.
Well, what about individual clients who want to file their personal tax return? Do they have to wait until their employer provides them with a Form 1095-C?
Well, the IRS said that the impact is going to be minimal. If it turns out that the 1099 shows otherwise, the taxpayer is not going to be required to file an amended return. And this means it's not going to impact the premium tax credit this year. It doesn't impact, for example, employees who have taken employer-sponsored health coverage. It doesn't impact people on Medicare, and it doesn't affect people who signed up for coverage on the marketplace and are receiving the premium tax credit on an advanced basis.
Since you mentioned W-2 forms, Barbara, tell me, didn't I hear that there's going to be a change in next year's filing date for 1099 forms?
Well, yeah, we're going to have to submit the transmittals for the W-2s and the 1099 MIS that we issue to our employees and our independent contractors at the same time that we furnish them to the employees and independent contractors. So this is for next year. So for 2016 W-2s and information and returns, we're talking about January 31st, 2017.
I recall you told me a few months ago that the IRS was increasing the penalties on delinquent and incorrect information returns. What happens if those deadlines are missed?
Well, penalties could apply, but the IRS has indicated that it's going to take into account any reasonable steps that the employers have taken to prepare for issuing these information returns when they're making determinations about whether to abate penalties.
Sometimes it's not a missed deadline, but an incorrect dollar amount. Are those automatically subject to the new penalties? I mean, can't some amounts be too small for penalties?
Well, yes, there's going to be no penalties for de minimis errors on information returns and statements, meaning you're not going to have to file amended returns or statements.
Well, that's good news. So tell me, what does de minimis mean in this case?
It's errors of $100 or less, or in the case of income tax withholding, $25 or less. We're really talking very de minimis.
Speaking of good news, absolutely no one is looking forward to the imposition of the so-called Cadillac tax on overly generous health plans. Is it true that the new law postponed that unpopular provision?
There are many rules covered in the PATH Act. It delays, for example, the excise tax on medical devices and on Cadillac health plans. So there's a lot in there to look at.
Well, Barbara, if you don't mind, let me ask you a few more questions about the PATH Act. In recent years, you've told me about the exclusion of gain on the sale of so-called qualified small business stock. What's the fate of that provision?
Well, the 100% exclusion is now permanent. It applies to Section 1202 stock issued after September 27, 2010. But remember, when you're preparing 2015 returns, likely you're going to be dealing with the old 50% or 75% exclusion, depending on when the stock was issued. So you really have to check on this.
With all of these provisions, did Congress really have time to decide the level of alcohol for a beverage to be taxed as hard cider rather than as sparkling wine?
Well, actually it did. It also considered electric motorcycles and NASCAR complexes. A lot of territory was covered.
But the good news is that we now have some permanency with the tax code, don't we?
Yes, there are two. First of all, the period for the built-in gains tax has been permanently reduced. It had been 10 years, and now it is 5 years, and that's permanent. The second provision relates to basis adjustment when the corporation makes donations of appreciated property. Shareholders reduce their basis by their share of the corporation's adjusted basis in the property and not their share of the corporation's contribution, which is the fair market value of the property. So when you're donating appreciated property, you have a smaller basis reduction, even though you get to take the charitable contribution based on your share of the property's value.
Earlier this year, we provided you with coverage of the tax issues involved in Congress's temporary funding of the Highway Trust Fund. You may recall that the Surface Transportation Improvement Act was funded with a number of provisions related to tax compliance, such as a redesign of how mortgage interest is reported on Form 1098, and a new requirement to report the date of death value of assets to estate beneficiaries. The good news is that for the first time in a decade, Congress has enacted a long-term, fully funded highway trust law. The even better news is that the funding for the new law does not involve changes in tax compliance. However, the Fixing America's Surface Transportation, or FAST, Act does contain two measures involving those taxpayers who are seriously delinquent in their tax accounts.
Well, besides the PATH Act, I heard that Congress also enacted Highway Trust Fund legislation called the FAST Act. What, if anything, does this have to do with taxes?
Well, there were two tax-related measures in the law. First, taxpayers who are seriously delinquent in their federal taxes will not be able to get a passport, or if they have one, their passport may be revoked.
I heard you say seriously delinquent. Does that new law define what's a serious tax delinquency?
Well, the law defines a serious delinquency as owing more than $50,000 and being under a levy or a lien. Of course, taxpayers who are trying to work out their problems with the IRS, for example, those who are using an installment agreement, are not going to have their passports affected at all. So it's really only the taxpayers who are delinquent and have gone through a process, that's why they're under a lien or a levy, and they're just not paying.
Okay, so the serious delinquent taxpayers can lose their passports, but are there any tax consequences for them?
Well, this one is a déjà vu provision. It allows for private debt collectors. You remember that we've tried this twice in the past and it's failed. We did this in 2006 and 2009, and in both cases the process was not successful. But we'll try again and we'll see.
The way the new law reads, these private debt collectors will only go after accounts that the IRS considers, quote, inactive, end quote. And there's a whole definition of what that means. But tell me, when and how does this go into effect?
Well, it applies to taxes outstanding as of December 4th, 2015. So we'll have to wait and see what IRS guidance has to say.
Last year, we provided you with coverage when the U.S. Supreme Court issued its opinion in the Obergefell case, generally requiring states to license a marriage between two people of the same sex. Just before year-end, the IRS issued Notice 2015-86, providing guidance in a question-and-answer format on the application of federal tax law to qualified retirement plans and to health and welfare plans, including cafeteria plans, in light of the Supreme Court's decision.
Before we conclude this month's discussion, Barbara, can you tell me about some of the issues that the IRS covered in its guidance to employee benefit plans?
Well, employers had the option of applying the Windsor decision to same-sex spouses of employees prior to June 26, 2013. That was the date that the Windsor decision came down. And what this is now permitting under the guidance is that employers can now make this retroactive election, if you will, to include these same-sex spouses in the plans.
Well, that makes sense. Was there anything else?
Well, again, plans were not required to include spouses, including same-sex spouses, in the health plans or other plans, but if they did, and then now a state has, in light of the Obergefell decision, redefined who's a spouse, plans may have to go back and change things. They may have to make amendments reflecting the decision and the new definition of spouse to include same-sex spouses in their plans.
A few minutes ago, Becky mentioned cafeteria plans. That refers to more than just where employees eat their lunch, doesn't it?
If the cafeteria plans includes the same-sex spouses in benefit options, then participants can change elections. They can revoke or opt to include these same-sex spouses, and there's guidance on what to do about this.
Since we're discussing IRS guidance, Barbara, and since most of our viewers and their clients have websites these days, let me ask you, has the service said anything about how to treat the costs related to the purchase of a website or a domain name?
There's been a chief counsel advice on this subject, and basically, because domain names have an indefinite life, arguably they should be capitalized. But the advice that came down here said that in situations that we'll define in a moment, they can be treated as intangibles, which can be the cost of which can be amortized over 15 years.
Okay, I know that domain names are registered trademarks, and that trademarks are treated as Section 197 assets. But it sounds as if the new IRS guidance addresses those domain names that have not been trademarked.
Exactly. As long as the domain name is used to distinguish a company's goods or services from those provided by other companies, then it's the intangible that can be amortized over 15 years.
So the IRS ruling distinguishes generic from non-generic names. A generic name describes the product or services, like pizza.com. But a non-generic name is usually the company's name. So tell me, from a tax perspective, does it matter which one the taxpayer has bought?
Well, both can be amortized. For the generic name, it could be treated as a customer-based intangible, and this would be if it's already associated with a website that's already been built and used to increase the company's market share or sell its goods and services.
Barbara Weltman, thank you once again. I look forward to seeing you after busy season.
Thanks, Mike. See you next time.